There's still a pretty significant lender appetite for retail, even though there's been some headwinds in the market. Lenders are definitely more concerned now with looking at absolute rent levels and making sure that the tenants are paying market rent. May have some issues where tenants are potentially paying above market, so lenders are writing those rents down to market. But generally speaking, there's still a good amount of liquidity in the market, and we've been very successful at getting our retail deals placed. The variety of capital sources still active: CMBS, banks, and life insurance companies predominantly.
The retail landscape is tricky, and everyone knows that right now. I think the Amazon effect has had a massive impact on the entire business. You're still seeing tremendous lender appetite when you're looking in strong markets, strong locations, and strong operators. So if you have high street retail, if you're in Los Angeles, San Diego, Chicago, New York, in core markets, there's still no shortage of capital for that product. I think lenders get spooked when you're going to secondary markets, when you have mom and pop operators and you see a lot of shutdowns occurring. It's changed heavily as far as what they're willing to lend, the type of assumptions lenders are underwriting. I think you're seeing a longer drag on just the amount of time it's going to take to fill a center. The amount of money that people expect to fill for TIs has increased, obviously. But I think in general, if you're in a strong market with a strong sponsor, there's still no shortage of capital.
Lender appetites have changed for retail in the past 18 to 24 months. There's a heightened emphasis on tenancy and having tenants in place. What I've seen is a move toward lenders being a lot more open and amenable to making loans on shorter term leases. I find the portfolio lenders are quicker to lend on pop-ups of 2 and 3 years. And on the sales side, we've already eclipsed as closed sales. In Q1 of this year, we actually eclipsed all 4 quarters of last year. I attribute it to real estate owners understanding there's been a paradigm shift in pricing.
Well, we're able to serve them fully. So now we have the full scope of capital markets in real estate. We can finance something, we can sell the property, and we can also serve our clients on the leasing end. So we really complete the full circle.
I think that we're moving towards a more stable place. I think in the last 12 to 24 months, rents have come down. There's been a lot of vacancy, but in urban spaces, I think there's a lot of new tenants and a lot of new concepts that are coming into those vacant space. I think the leasing brokers are being more creative. There's a lot of pop-up stores, a lot of short-term leases, a lot of co-working spaces. So I think retail in general is changing, but I think it's healthy. It's just not what it used to be.
So I think we're probably midway through in the cycle. I think in this environment you have to be nimble and you have to think outside the box. You have to look for non-conventional retail. We're seeing the service side of the business, the food side of the business, and the fitness side of the business extremely active.
And now that we have other lines of business, how are we able to serve our clients? Much like major international law firms where you'll come to them with one need, but you'll realize there are other suites of services, it was a logical extension of Meridian's business.
I think we've really grown our franchise, and I think adding in investment sales and retail leasing and really becoming more of a diversified real estate services company enables us to kind of keep our clients in-house and grow organically, which is important. Also, I think the low interest rate environment has kind of helped us keep a lot of financings active, and the refinance market is vibrant. And also the investment sales market is starting to heat back up. So I think all those factors combine to allow us to have a very successful year.